Yeah, that's up there, but I think I would first go to probably Canadian home bias. It is the biggest mistake, and it's just a lack of geographic diversification. Canadians are fascinated with their own stocks. And again, sometimes, we like to buy what we know and what we see, what we're comfortable with.
Building a portfolio used to be the hard part, but now for many investors, the bigger challenge has become how do you actually turn that portfolio into reliable cash to fund your retirement? Today, I'm joined by Dale Roberts from Cut the Crap Investing, and we're going to unpack how investing has evolved, really from the OG simplicity of the Canadian couch potato portfolio to all-in-one low-cost asset allocation ETFs, and what potential solutions are available when it comes to that shift from growing your money to actually living off of it in retirement. Before we get started, a quick reminder that we are not providing investment advice or recommendations today. Today, as always, is about providing DIY investors in Canada information and education. So joining me today, as I mentioned, is Dale Roberts. Dale is the founder of Cut the Crap Investing and one of, I would say, Canada's most recognizable voices when it comes to DIY investing. He has his website, cutthecrapinvesting.com, and has also launched what he's coined the Retirement Club as a resource on his site for this particular segment of investors. Before launching his blog, he spent years as an investment advisor. Before that, even in advertising. And he's been a longtime contributor to the Money Sense magazine as well. Dale, your views at the time were sort of disruptive, and they really did shine a light on the fact that Canadians are paying some of the highest fees in the world. And you really sort of challenged the status quo and focused on how to build smarter, more cost-effective portfolios. So I'm a big fan, and it's great to have you on the channel today, Dale.
Thank you so much. I greatly appreciate the invite, and always appreciate the opportunity to talk about simple and effective portfolios. So thank you.
For sure. I first came across your work, I think with Money Sense, I don't know, it must have been 15 years ago, around the Canadian couch potato approach to investing. Let's start there, and maybe at a high level for our listeners, what is the thesis behind this approach and why did it attract you?
Sure. So with a couch potato portfolio, again, we can create the greatest amount of diversification with the least amount of effort. Hence the title that it's often given with being a couch potato. You can be really lazy and do it. And the greater diversification can help lower the risk. As they say, very common phrase, which is true, is that diversification is the only free lunch when it comes to investing. So the approach is the couch potato approach is to buy or own the global stock markets and then manage the risk with bonds of various sorts. And with our bond exposure, we can dial in the appropriate risk level. And we can argue that it's the most passive portfolio that you can create. We're using the cap-weighted stock market indices. We're not trying to beat the market. We are just buying the market. And again, we're not another common phrase when we approach this. And what I would use when I was working on index-based portfolios for clients is we're not looking for the needle in the haystack. We are buying the whole haystack. Or an analogy that I would create too is, which is a sports analogy. If we look at the NHL, we're not trying to pick one team that might, win the Stanley Cup or go to the semis, like pick one team, two teams. We're going to own the entire NHL. We're going to own the entire league. And when the league prospers, you prosper. You don't have to pick the winners. If you will, the winners are going to rise to the top. They're going to be the cream, and you're going to own those. And in this style of portfolio too, you actually own more who are those greater teams or those greater winners over time. And on the investment front, those greater winners are the greater stocks and even the greater stock markets over time. So another great benefit to this, of course, is that it can just lead to better behavior because it's passive.
Yeah, you don't get those big jumps in your portfolio because you're a little bit more diversified, and hopefully you can hang on a little bit when we have these corrections, right?
Yeah.
You are a clear proponent of ETF investing rather than picking stocks. Tell us about why these are such a great tool and why asset allocation is more important than picking stocks.
Yeah. And again, I'll never tell anybody, how to invest. You can create a very good stock portfolio if you go that route. But essentially, when you do that, you're creating your own index, if you will. But I think for most investors, asset allocation portfolios, ETFs, is the way to go. And that's reflected in when I look at readers' portfolios, and when I actually did that in a professional manner, where I would do a lot of portfolio analysis for our clients. So on that, asset allocation is so important because asset allocation determines our returns and our risk level. For our risk level, it really is that stock to bond ratio. And then the risk return proposition is at play, of course, where we take on more stocks, more equities. We're typically over longer periods going to get more or greater returns. And our geographic allocation is important as well with respect to growth and risk management. And for example, Canada greatly complements the US. US might have the growth. I'll often say that's where they keep the best companies on earth. But in Canada, we have some greater stability at times, or most times, and greater inflation protection due to energy, materials exposure. So they make a nice complement, if you will. And then again, international stocks, whether it be developed or developing markets, are going to fill in some more of the blanks. And on that, asset allocation and ETFs, indices versus stock picking. With picking stocks, obviously, it's going to bring a lot greater volatility. That can be greater risk. And sometimes there's too much activity with the investor. There's that saying, portfolio is like a bar of soap, and the more you handle it, the smaller it gets. So I think that holds true, and I see that a lot when I look at client portfolios reader portfolios of the blog, and even with Retirement Club. You can just tell the more that they've handled it, and the more that they'll admit that they've been looking at everything, changing stuff, it just gets smaller, right? The beauty of the asset allocation portfolios, or building your own ETF portfolio, is just the passive, hands-off nature.
Yeah, the ETF industry has really made a great tool for investors in these asset allocation ETFs. I think there's still work to be done on trying to find out for you as an investor what asset allocation is best fit for you, right? That's still the number one most important decision. You want to be in the right mix that you can stomach, that's going to help you get your goals. So you've taken one step of the way.
We need to know which one to get in, or ones to get in, because it's an account by account process, if you will. But even on my blog and Cut the Crap Investing, I put in tables, just a very simple framework. You could say, because I worked on asset allocation ETFs, I'm classically trained, if you will, right? That we had to start from the very core, and then how to match the portfolios to the client needs, time horizon, risk level. And then, of course, every account in retirement will get its marching orders from a cash flow plan.
You've spent a lot of time talking to DIY investors in your career, and I'm curious as to from where you're standing, what's the biggest mistakes that you see Canadian investors making? Is it touching their portfolio too much, or what other mistakes are we seeing?
Yeah, that's up there. But I think I would first go to probably Canadian home bias, right? Is the biggest mistake, and it's just a lack of geographic diversification. Canadians are fascinated with their own stocks, and again, sometimes we like to buy what we know and what we see, what we're comfortable with. Canadians, again, we love our dividends, because we're typically in an area where we're flush with very good dividends, very good growing dividends. And again, that can just lead to too much of a Canadian home bias. And again, obviously over the last 10, 15 years, that would have hurt us if compared to adding more of the US stocks, which have just blown away everything. And I guess, and after that, I guess it would just be when they form their own portfolio, it would be concentration risks. Just too few stocks within the portfolio. And I'll admit, I've been guilty of that as well. And even then again, chasing those dividends and chasing high yield would be another mistake. Investing outside of our risk tolerance level, I would say potentially is one, but we just don't know, because nobody's been tested, right, for so long. It's something I'll say when I'm chatting with investors or folks on Retirement Club, and that eventually in retirement, we're all going to get punched in the gut, right? We're all going to get punched in the head. And like using that Mike Tyson a saying that he had, he goes, everybody has a plan until I punch them in the face, right? It's kind of the same. We come in, we get a retirement plan. We're going to get punched in the face, right? Once or twice or three times. But at this point, for most, we haven't been through any kind of major correction. And I wouldn't even call the COVID a real recession or real correction, because it was just corrected by government bodies so quick. And at that point, I would think that we all don't really know what our risk tolerance is right now. And I'm probably guilty too, like everybody, because we just all think we're geniuses. Everything's working great. You can't go wrong.
Yeah.
Even if you're not doing as well, okay, even underperforming by 2, 3, 4%, still looks great.
Now, you've been around, you were around when the asset allocation ETFs first came to market. What was your thoughts there? Is that something that you were asking ETF providers for? And do you think that this has essentially replaced, what we may have known as before as the 3 ETF portfolio that was popular back then?
Yeah, I think, I was always chatting about that. And again, I did work on probably what you call the first like robo advisor in Canada, if you will, right? And working in an advisory capacity and even training folks at one of the banks on that. And I think, yeah, there's just enough chatter about that, about how good a simple approach is. And lots of voices on that front, right? It was really more about building your own ETF portfolio, just with simple building blocks. And I think that was just enough for like folks at BMO and elsewhere, just to see like there's such a great opportunity here to build a complete portfolio or a more complete portfolio in simple fashion that's managed. They don't have to touch it. It does everything they need to be. It takes away that hands-on too much, that soap thing, right?
Mhm.
And I think what they've done over, let's say, core ETF portfolios, which again might be 3, 4 ETFs. I think the asset allocation ETFs are a bit of a step up because again they're able to do more things on, say, on the bond front, maybe add more direct exposure to emerging markets, mid cap and small cap, which can sort of stray away or undo some of the large cap bias that folks are worried about. And I think it'll evolve too. But I would give good marks to the folks that have put out asset allocation ETFs out there to not tinker too much.
Switching gears a little bit, you've been doing more writing around retirement, and you've started this. When did you start the retirement club? But I want you to talk to us a bit about what's going on in this segment of the market when we look at retirees and what's really changing for them when it comes to that stage of their investment journey.
Sure. Yeah. So we started a retirement club at the beginning of 2015, just looking at my blog readers and such, that most were doing quite well and were a little older, either approaching retirement or in retirement. And it's obviously they needed a little more attention, a little more hands-on, and even a hub, right? Because we do have an online community space where we all connect, share ideas, do presentations and such. But it just felt like it was needed to have sort of a one resource, if you will, hub that folks could go to and learn to have pretty much everything they need in core manner, if you will, to manage the retirement. Obviously, advice is going to be needed at certain stages, but it just seemed, for my readership anyway, it was needed. And again, sort of the challenges too is it's really hard for folks to flip that switch from proud and successful accumulator investor to big spender. So again, we need that life plan at the beginning. We need an optimized retirement cash flow plan. We need to know the best time to take CPP, old age security, might have an employer pension in the mix. But then again, we need to learn when and how to draw down on those investment accounts. And again, it starts with that life plan, but then on to the retirement cash flow calculator. You can learn that for yourself, or you might contact an advice-only planner who's a retirement specialist. At May Retire, we've kind of settled on, Retirement Club, we've settled on May Retire. It's a very good free use retirement calculator. And actually the creator of it is actually a retirement club member. So it's nice to have him. He typically chimes in all meetings, but it really just comes down to just getting from the life plan right through to the cash flow plan. And again, it's just almost the complete opposite of the accumulation stage.
Yeah, what are the challenges that investors face when it comes to retirement? What are those friction points when it comes to actually drawing an income from their portfolio?
Yeah, I guess I think most would just complicate things too much, or think that it is more complicated than it actually is. And fortunately, retirement research, and there's a mountain of it. It really comes down. It actually uses simple balanced portfolios, right? Even starting with the 4% rule and beyond. There's a mountain of that research. It's on even more simple portfolios, again, that we would see in asset allocation ETFs. But again, I always just share that simple works in accumulation, and simple can work in decumulation as well. And again, then we can shape the portfolio in different ways if we like. It's a personal choice. We don't always have to stay so core. And then we talk about core and explore and accumulation. Retirees might approach things a little bit differently. I certainly have mine where I'll shape to defensive equities in the mix and also some dedicated inflation protection, which is a little bit different than a core asset allocation ETF. But even like you guys, BMO, you have one of my favorite topics would be like ZLB.
Yes.
There's low volatility, right? Which if you look at the history, and again, past performance doesn't guarantee future returns, we have to say. But that approach has a really nice long-term history of beating the market with less risk. And who doesn't want that typically at any stage, but especially in retirement? And again, there's other research to back that up going beyond the life of ZLB, if you will. And Norm Rothery in the Globe and Mail, of course, he tracks and follows a lot of good low volatility portfolio models. In his research, you can go back even further. So for me, as a semi-retiree, I do a bit of both. I do some core, but I do shade in the defensive and I shade in dedicated inflation protection. So everybody's can do their own thing. But again, that said, you don't have to because it is shown that just core works and core asset allocation works too. If you look at Canada, U.S. international on the stock front, and then bonds, whether it be Canada or Canada, U.S., and some international. And it even works when we talk about inflation protection, but just, core balanced portfolio even work through, if we look to the 4% rule of, delivering 4% income from the starting point, increase for inflation each year, a core balanced portfolio will work through stagflation on that front. So it doesn't mean you have to go that route, but obviously if you have dedicated inflation fighters and we go through energy shock that may be developing today or not, or stagflation period, you're gonna do a little better. So
you did a great coverage of our new target cash flow ETFs, a bit of an explainer on that front. I like to think of them as sort of the reverse of dollar cost averaging, and I think they are a good retirement solution. But yeah, like you think about dollar cost averaging or averaging into the market, fixed amount every month into an investment, and then decumulation. That's where target cash flow ETFs come in, providing that reliable cash flow out of the portfolio. Talk to us a bit more about these and what you thought about when you saw these come to market.
Just once again, absolutely fantastic because we could use a core ETF portfolio, create our own, and sell, enough assets each month to create the desired income. But again, they were hands-on, right? And just find a lot of retirees will say, I don't want the hassle of knowing what to sell and when do I rebalance? Do I have to rebalance? Should I just sell from the equities when they're great or just sell from the bonds and cash when it's not so great? And all those questions just go away, right? Because they can just set up how much income do they need. They can set it up again with, again, a BMO, a T series, using Z-Val, Z-Grow, ZEQT. You can just put in the amount of the ETF, if you will, in that space or in that account, and just we know it's going to pay out at 6% spend rate based on the starting point of that calendar year or December 31 of the previous year, and it can just pay out income on a monthly basis. You can get it to go to your checking account if it, check with your institution and your bank, make sure that that's fine. But I understand it's typically the case. And again, you can just set and forget it. Yeah. Right? Like you're probably going to typically look at it each year because your cash flow plan is going to change each year. But once again, it just takes all the hands-on stuff that you have to do. They're going to be risk managed. They're going to rebalance for you, and it's just simplicity, right? But it's simplicity in the decumulation. And again, get a cash flow plan, figure out how much you need. You can set it up. And if you need more, obviously there's things you could do. You could have a bit of a cash pile waiting in there or move that out early, and probably just take a look at it each year and set it and forget it. So I think it's more of that hands-off approach that folks are looking for.
Yeah, we sort of, the conversation of these came up because we saw a lot of investors going towards covered call ETFs and these high distribution yields that are advertised 10, 12, 14%. And we recognize, hey, what these people really want is reliable cash flow.
They want to get paid.
Yeah. And maybe it has nothing to do with the strategy. Maybe you could have any strategy underneath that structure. So that's where we've sort of gone is we've launched these T-series on both our asset allocation ETFs and our covered call ETFs for those who want to take a higher payout on those. But we haven't changed anything about the underlying structure. And I think this leads to sort of that yield versus total return conversation that I wanted to discuss with you. What misconceptions do investors have when they see that 10%, 12% payout, and how should they be thinking about yield versus total return?
Yeah, that's a great question. One of my favorite topics, actually. I think the greatest misconception is people think there's value in a dividend, right? And it's shocking to them, and you'll get unfollowed when you say this on Twitter often. But it's like in the accumulation stage, the dividend is of no value, right? It's just it's a removal of value. They do not contribute to wealth creation. And again, that's just too much of a head scratcher, a head banger for a lot of people who've dedicated maybe their investment career to dividends, and they've done really well. It doesn't mean that they can't do well by taking those dividends, reinvesting. But again, all they're doing is the share price drops on ex-dividend day, they're just owning more shares. There's no actual wealth creation. And then in retirement, again, there's no benefit to the dividend on the risk front. So again, there's no difference between a share sale and a dividend of equal value, right? Now, there can be, other than tax treatment in a taxable account, that can be a different event. But on the actual risk side, with cash flows, they are the same. They're just removing money from your holdings. And again, on the risk front, it's absolutely the same. So given that, the superior portfolio will win. So if you're dividend agnostic and even income agnostic to chasing higher income stuff, now you're free to build a superior portfolio. And that superior portfolio might be an asset allocation ETF because it's managing the risk by Canada, US, international, emerging markets, bonds in the mix at your appropriate risk level. So you're just free to own a higher quality portfolio. I would stretch that even further to, let's say, if one were to add consumer staples, which is sort of the king of defensive equities, if you will, along with utilities and healthcare. And BMO has some wonderful options on that side. Those are typically really, really low income, low dividend. But again, they're probably better if history repeats on the income front. It doesn't matter what the dividend is from those. It's just we're taking money from those companies and we're moving it out. Again, it's just more about understanding that. And then on the higher income front, greater success just comes by building a better portfolio. And again, just being income agnostic. Other than, again, in a taxable account, now then with the Canadian dividend tax credit, folks might do a bit of shading. But again, we have to be careful of not letting the tax tail wag the portfolio dog.
To drive home, target cash flow series, our .Ts, are not about chasing yield. It's a payout strategy, all based off of the underlying.
That's said out loud, and I've posted too that I understand if dividends help you behaviorally or income, then it's a win, right? So you can't tell someone, oh, you shouldn't do that. Like it's like, no, because I see so many people that have built such incredible wealth by maybe not doing it optimal or even say right, but it worked for them. So right, and now in retirement, they just like my dividend cash flow is amazing, and I've saved way more than I need, and great, it worked. Right, that's in the end, that's success. So it's to each his own, but at the same time, I'd feel like it's my responsibility to let folks know how they could do better if they choose.
For sure. Well, thank you so much, Dale, for all your insights today. It was an absolute pleasure. And to our viewers, make sure you check out cutthecrapinvesting.com. I've got that right, Dale. We'll put it in the link below.
Cutthecrapinvesting.com. Yeah. And there's a retirement club link at the top there to do a bit of an overview. Yeah.
For sure. Well, I appreciate you joining me today, Dale.
Thank you. Appreciate you having me on. Thank you.
That's all for today. Thanks for joining us, and we'll see you next time. Bye for now.